There are two kinds of wealth destruction. They are opposite physics. One kind rewards cash and government bonds. It punishes real assets and debt. The other kind rewards real assets and debt. It punishes cash and government bonds. The same diversified portfolio, 60% cash, 30% treasuries, 10% gold, survives one regime intact and gets destroyed in the other. The historical record is precise about this. Almost nobody in modern financial media frames the question this way. The conventional diversified portfolio is optimized for one of these two regimes. Most investors today are running the playbook for the wrong one. Theodore Ashford was a retired bank clerk in Boston. He retired in October of 1929. He had spent 38 years building a portfolio. 60% cash and savings deposits, 30% in long treasury bonds, 10% in gold sovereigns kept in a floor safe. Within 10 years, he had bought a second house in Cambridge at the 1933 market bottom for 60% below its 1928 price. His purchasing power was intact. His standard of living was higher in 1935 than it had been in 1929. Raymond Ashford, Theodore's nephew, retired from a Cleveland tool and die shop in October of 1971. He had read his uncle's letters from the 1930s. He copied his uncle's portfolio exactly. 60% cash, 30% treasuries, 10% gold. By the end of 1980, Raymond had lost 54% of his real purchasing power on the cash. His treasuries had been devastated by rising rates. Only the gold sliver, 10% of the portfolio, saved him from destitution. Same portfolio, same ideology, opposite collapses. Theodore prepared correctly. Raymond did not. The difference was not the quality of their preparation. The difference was the type of wealth destruction each was preparing for. My name is Ben. I have been reconstructing the two physics of wealth destruction across 6 months of research using the Bureau of Labor Statistics Historical Consumer Price Index series back to 1913, the Federal Reserve's FRED database for real interest rates, money velocity, and yield curve data, the Ibbotson SBBI Historical Asset Return Tables, the Federal Reserve History Essays on the 1933 banking crisis and the 1951 Treasury-Fed Accord, Adam Ferguson's When Money Dies on the Weimar Inflation, and the recent academic work on Argentina's 2001 Corralito and Japan's 1990s deflation. I'm going to walk you through 3 deflationary collapses: the United States from 1929 to 1933, Japan from the early 1990s to today, and the 2008 global financial crisis. Then 3 inflationary collapses: the United States from 1971 to 1980, Weimar Germany from 1921 to 1923, and Argentina across the past 4 decades. Each case has a named outcome for the same 5-asset allocation that Theodore Ashford used. By the end of this video, you will know exactly which physics is operating right now in the United States, the 6 diagnostic questions that tell you the regime, and the 4 assets that survive both regimes. Subscribe to the channel before we continue. Hit like, share this video with anyone running a conventional diversified portfolio without asking which physics it is built for. Most viewers reading their April CPI print this week are still running the wrong playbook. The information they need is not on financial television. It is in the gap between 2 historical records. Let me define the 2 regimes precisely. Deflationary destruction is when prices fall. Debt becomes heavier in real terms because every dollar of debt requires more goods and services to repay than it did when the debt was issued. Cash gains purchasing power because the same dollar buys more next year than this year. Real assets, houses, land, businesses, commodities lose value in nominal terms. Stocks fall, real estate prices collapse, wages get cut, layoffs follow. The economy contracts. The Federal Reserve's standard response is to lower interest rates and inject liquidity. That response can take years to work. Sometimes it does not work at all. Japan has been trying for 35 years. Inflationary destruction is when prices rise. Debt becomes lighter in real terms because every dollar of debt requires fewer goods and services to repay than it did when the debt was issued. Cash loses purchasing power because the same dollar buys less next year than this year. Real assets gain value in nominal terms. Stocks may rise, but the gains can be illusory in real terms. Real estate prices rise. Wages rise, but not as fast as prices. The economy can grow in nominal terms while contracting in real terms. The Federal Reserve's standard response is to raise interest rates and reduce liquidity. That response works eventually. The cost is a recession, sometimes severe. The Volcker recession of 1980 to 1982 is the canonical example. These are opposite regimes. The optimal asset allocation for one is the worst possible allocation for the other. The conventional financial advisory framework, 60% equities, 30% bonds, 10% alternatives, is calibrated for moderate inflation in the 2 to 3% range, which is neither true deflation nor true inflationary destruction. When the regime shifts towards one or the other extreme, the conventional portfolio breaks. The first deflationary case, the United States, 1929 to 1933. The Consumer Price Index fell approximately 25% over the 4 years. A dollar held in cash in October 1929 bought $1.25 worth of 1929 goods by March 1933. The same dollar held in equities was worth approximately 22 cents at the 1932 bottom. Long Treasury bonds returned approximately 17% in real terms over the 4-year period because deflation increased the real value of every fixed-rate coupon payment. Gold, fixed at $20.67 per ounce under the gold standard, technically held its nominal value, but was effectively confiscated by Roosevelt in 1933 under Executive Order 6102. Real estate lost approximately 50% in nominal terms across most American cities. Theodore Ashford's portfolio worked perfectly. His 60% cash gained 25% in real purchasing power. His 30% treasuries returned positive 17% real. His 10% gold was confiscated, but at the pre-confiscation price, not destroyed. The losers were everyone holding equities, real estate, or any leveraged position. Margin calls cascaded through the banking system. 9,000 banks failed between 1929 and 1933, as documented in earlier scripts in this series. The decision-makers who built balanced portfolios with significant equity exposure, the conventional sophisticated allocation of 1928, lost between 50 and 70% in real terms across the 4 years. Theodore's conservative cash-heavy portfolio gained. The second deflationary case, Japan from 1990 to today. The Nikkei stock index peaked at 38,915 in December 1989. It did not reach that level again until 2024, 35 years later. Japanese commercial real estate fell approximately 87% from peak to trough over the same period. Consumer prices in Japan ran near zero or slightly negative for most of the period between 1995 and 2021. The Japanese 10-year government bond yielded under 1% for most of the period between 1990 and 2021. Holders of Japanese government bonds did not lose money in nominal terms. They earned a positive real return because there was no inflation to erode the coupon. Holders of Japanese equities, real estate, or any leveraged position lost catastrophically. The 30-year Japanese deflation is the longest-running modern case of Type 1 wealth destruction. Anyone who held the Theodore Ashford portfolio in Tokyo in 1989 would have preserved purchasing power across the entire 35-year period. Anyone who held the conventional 60-40 equity bond portfolio recommended by Japanese banks at the 1989 peak lost approximately 70% of real value over the next decade. Japan is the example almost nobody points to because the conventional financial advisory framework has no good answer for it. The third deflationary case, the 2008 global financial crisis. From October 2007 to March 2009, the S&P 500 fell 57%. The Case-Shiller National Home Price Index fell approximately 27% peak to trough. Consumer prices fell briefly into negative territory in 2009. Real estate-linked debt instruments collapsed. The Lehman Brothers bankruptcy of September 15, 2008, triggered a sudden contraction in credit markets. Holders of cash and treasury bonds gained in real terms. The 10-year treasury yield fell from approximately 5% in 2007 to approximately 2.1% by late 2008, producing substantial capital gains for existing bondholders. The Federal Reserve's
reserve's quantitative easing eventually reflated the economy, only after substantial damage to equity and real estate holders. Gold, by then freely tradable for Americans since 1974, rose from approximately $750 per ounce in October 2008 to $1,900 by August 2011. The Theodore Ashford variant, heavy cash, heavy treasuries with a gold sleeve, outperformed the conventional 60-40 portfolio by approximately 25 percentage points across the 2007 to 2011 period.
Now the three inflationary cases. The first is the United States from 1971 to 1980. Consumer prices rose approximately 104% across the period. A dollar held in cash in 1971 bought approximately 49 cents of 1971 goods by 1980. Regulation Q held savings deposit rates artificially low while inflation ran double-digit. Long Treasury bonds, the asset that had returned positive 17% real for Theodore, lost approximately 45% of real value across the period for Raymond. Stocks ran approximately flat in nominal terms, but lost approximately 50% in real terms. Real estate, the asset class that destroyed equity holders in the 1929 to 1933 deflation, was the single best performing asset for ordinary Americans across the 1971 to 1980 inflation, rising approximately 140% in nominal terms and roughly preserving real purchasing power. Gold ran from $35 per ounce to a January 1980 peak of $850 per ounce, a 24-fold increase that more than offset the inflation of the rest of any conventional portfolio. Raymond Ashford's 10% gold allocation, the same 10% that was confiscated from Theodore in 1933, was the single asset that saved him from destitution. Same portfolio, opposite outcomes, different physics. The second inflationary case, Weimar Germany, 1921 to 1923, the most extreme inflation in modern industrial economy history. The German mark went from approximately 65 marks to the dollar in January 1921 to 4.2 trillion marks to the dollar by November 1923. A saver with 100,000 marks in a German savings deposit in January 1921, approximately $1,500 in purchasing power, had a deposit worth approximately 1/1,000,000th of a cent by November 1923. The savings were not partially destroyed, they were totally destroyed. The middle-class German savers, pensioners, and bondholders of 1921 were impoverished as a class. They were the people who supported the Weimar Republic. Their impoverishment is a major reason the Republic fell. The people who did well in Weimar held tangible assets, farmland, factory ownership, foreign currency, gold. Hugo Steens, the German industrialist, borrowed marks aggressively in 1921 to buy mines, ships, and newspapers. He repaid those loans in 1923 for almost nothing because the marks had become worthless. He became briefly one of the wealthiest men in Germany. Debt was an asset. Cash was a death sentence, the exact opposite of 1929 to 1933 in the United States. The third inflationary case, Argentina across the past 4 decades. Argentina has experienced major currency crises in 1975, 1989, 2001, and the present day under the Milei reforms. The most documented case is 2001 to 2002. On December 1, 2001, the economy minister imposed what Argentines call El Corralito, Spanish for Little Corral. Bank accounts were frozen, cash withdrawals were capped at 250 pesos per week. 20 days later, after riots, the president resigned. The country cycled through 5 presidents in 12 days. The peso-dollar peg, which had held since 1991, broke in January 2002. Depositors lost approximately 60% of their savings in dollar terms across the conversion. By October 2002, the national poverty rate had reached 57.5%. The Argentines who did well held what they call colchón dollars, mattress dollars, physical American $100 bills kept outside the banking system.
The Argentine documenter Fernando Aguirre noted that silver coins were more useful than gold coins because you cannot make change for a gold coin when you want a dozen eggs. A barter network using a homemade local currency called the Crédito eventually included 2.5 million Argentines. The pattern across all four Argentine crises is identical. Local currency savings go to zero. Tangible assets hold. Hard foreign currency in small denominations is king. Social networks substitute for market systems. Anyone running the Theodore Ashford portfolio, cash and treasuries, was wiped out. Anyone running the inflation playbook, tangible assets, foreign currency, real estate, preserved wealth.
Now, here is the part that almost nobody connects for the modern audience. The Federal Reserve has misdiagnosed the regime twice in the modern era, and both times the misdiagnosis cost American savers a decade. The first misdiagnosis was 1936 to 1937. Commodity prices had risen across 1935 and early 1936 as the economy recovered from the 1933 bottom. The Federal Reserve Board, led by Chairman Mariner Eccles before his PEG-era difficulties, looked at the commodity price increases and concluded that inflation was returning. The board tightened reserve requirements aggressively in 1936 and 1937. The economy was still fundamentally deflationary. The tightening produced what historians now call the recession within the Depression. Industrial production fell 32% between May 1937 and June 1938. Unemployment rose from 14% to 19%. The Fed had misdiagnosed Type 1 deflation as Type 2 inflation and applied the wrong physics. The cost was 4 million additional unemployed Americans. The second misdiagnosis was 1971 to 1973. Arthur Burns, then Federal Reserve Chairman, looked at rising commodity prices from the OPEC oil shock and concluded that inflation was a temporary supply-side phenomenon, what would later be called transitory inflation. Burns held monetary policy too loose for too long. The economy was fundamentally inflationary. The Fed had misdiagnosed Type 2 inflation as a temporary Type 1 phenomenon and applied the wrong physics. The cost was a decade of negative real returns for American savers and the eventual Volcker recession that broke the back of inflation expectations. 2 misdiagnoses, 2 decades lost. The Federal Reserve has institutional difficulty correctly diagnosing the regime in real time. Your financial advisor, working with information 1 or 2 steps downstream from the Federal Reserve, has the same difficulty multiplied. The conventional 60-40 portfolio recommendation assumes a moderate inflation regime that the institutional advisory system is structurally inclined to assume. When the regime is actually deflationary or actually severely inflationary, the recommendation breaks. The misdiagnoses are documented. The pattern is documented. The information is publicly available at the Federal Reserve History website. Less than 1 in 10,000 individual investors has read either the 1937 or the 1973 Federal Reserve internal records. Your financial advisor has not read them either. So how does an ordinary investor diagnose the current regime in real time? 6 questions. Run them in 15 minutes. They are publicly available from the Bureau of Labor Statistics, the Federal Reserve's FRED database, and the Treasury. First question. Are real wages rising or falling? Real wages are nominal wages minus inflation. In April 2026, real hourly wages fell 0.5% month over month and 0.3% year over year, according to the Bureau of Labor Statistics. Falling real wages are an inflationary signal. Workers are losing ground against prices. Second question. Is consumer price inflation accelerating or decelerating? April 2026 headline CPI was 3.8%, up from 3.3% in March. Acceleration. Inflationary signal. Third question. Is money velocity rising or falling? M2 velocity was 1.409 in the fourth quarter of 2025, historically low but rising from the 2020 trough of 1.13. Rising velocity is inflationary. Money is moving faster through the economy. Fourth question. Is the yield curve steepening or flattening? The 10-year minus 2-year Treasury spread is approximately 53 basis points in mid-May 2026, positive and steepening after a long period of inversion. A steepening curve with positive nominal growth is inflationary. Fifth question, are commodities leading or lagging the broader economy? Energy prices rose 17.9% year-over-year in April 2026. Gasoline rose 28.4%. Commodities leading is inflationary. Sixth question, are housing prices rising in real terms or falling? Case-Shiller national home prices have continued to rise in nominal terms through 2025, modestly outpacing inflation in most markets. Rising real home prices are inflationary. The diagnostic is 6 out of 6 pointing toward inflationary regime, not deflationary, inflationary. The portfolio that worked for Theodore Ashford in 1929 to 1933 is not the portfolio for the current regime. The portfolio that worked for Raymond Ashford from 1971 to 1980, heavy real assets, heavy debt, light cash, gold sleeve much larger than 10%, is closer to the portfolio for the current regime. For instruments, 4 categories in the current regime, in order of priority. First, your emergency liquidity needs to earn at least the prevailing inflation rate. The FDIC National Average Savings Account currently pays 0.38% against headline inflation of 3.8%. The real loss is approximately 3.4% per year on every dollar in a default rate savings account. Top high-yield savings accounts currently pay between 4.10% and 5% according to current bank rate and NerdWallet surveys. CIT Bank at 4.10%, Pi Bank at 4.40%, Axos Bank at 4.21%, and Vero Money at 5%. Move your emergency fund to one of these. The move takes 30 minutes online. The downside is 0. The FDIC insurance is identical. Second, Series I United States Savings Bonds, sold directly by the Treasury at treasurydirect.gov. The interest rate has a fixed component set at purchase, plus an inflation-adjusted component that resets every 6 months based on the Consumer Price Index. The annual purchase limit is $10,000 per person, plus an additional $5,000 using a federal tax refund. Hold for at least 1 year. 3-month interest penalty if redeemed before 5 years. I-bonds are the single instrument the United States Treasury sells directly to retail investors that is structurally designed to defeat inflationary destruction. Third, gold exchange-traded funds, SPDR Gold Shares, ticker GLD, and iShares Gold Trust, ticker IAU. The 2 largest physically backed gold ETFs, both eligible for traditional and Roth IRAs without structural complication. A 5 to 10% allocation to gold is the historical standard recommended by Goldman Sachs, JP Morgan, and the World Gold Council across both regimes. It preserved value in 1971 to 1980 and held value in 2008 to 2011. Inside a Roth IRA, the gain is never taxed. Outside a Roth, gold is taxed as a collectible at 28% maximum federal rate. The IRA wrapper matters. Fourth, the 4-asset survival set. These are the assets that survive both regimes, regardless of which physics is operating. Productive skills. A plumber works in deflation and in inflation. A nurse works in both. A diesel mechanic works in both. The skill cannot be confiscated, devalued, or repriced. Productive land with clear title. Productive in the sense that it generates output, not productive in the sense of speculative appreciation. Diversified hard money, not just gold, but a mix of gold, silver, and stable foreign currency in small denominations. Dense human networks that span geographies. Relationships built before the crisis that can be activated during the crisis. These 4 assets do not depend on which physics is running. They are the underlying portfolio underneath the tactical allocation. Marcus Ashford is 54 years old. He is Raymond's grandson. He lives in Cleveland in the same neighborhood his grandfather lived in. He has approximately $320,000 in retirement accounts. He has a fixed-rate mortgage at 3.1% locked in 2021. He has $18,000 in a high-yield savings account at 4.2%. He has $6,000 in gold ETF positions across GLD and IAU. He has been reading his grandfather Raymond's letters from the 1970s and his great-uncle Theodore's letters from the 1930s for the past 2 years.
He has noticed something his grandfather and his great-uncle did not have access to: the diagnostic framework. 6 questions, 15 minutes. The Bureau of Labor Statistics, the Federal Reserve, and the Treasury publish the underlying numbers in real time. Marcus runs the diagnostic every month. The signals have pointed toward inflation regime for 16 consecutive months. He has gradually shifted his allocation: more gold, more I bonds, less long-duration Treasury exposure. His fixed-rate mortgage is his single best asset because every percentage point of inflation above 3.1% is a direct subsidy to his net worth. He is not running Theodore's playbook. He is not running Raymond's playbook exactly. He is running the diagnostic and adjusting. Theodore's playbook would have ruined him in the current regime. Raymond's playbook is closer to correct, but still requires updating for the modern instrument set. Marcus is doing what his grandfather and great-uncle could not. He is reading the regime in real time and adjusting his allocation to match the physics. The diagnostic is publicly available. The instruments are publicly available. The IRA wrapper is publicly available. The combination is the most powerful retirement protection toolkit in American history. Almost nobody uses it. The framework that prevents most investors from using it is the same framework that prevented Raymond from updating his allocation in 1973. The framework says cash and treasuries are safe. The framework was true for Theodore. It was false for Raymond. It is false again now. The physics has changed. The portfolio must change with it. This is BAN. 2 physics, 1 diagnosis. Choose carefully.